Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
Welcome back to the show. This is episode 265. Corey, we are on a roll, and I know we're recording this a day earlier than normal because you are headed to
Sonoma, California.
Sonoma, beautiful Napa Valley. I'm sure you're going to not drink any wine, are you?
I think we'll probably have some wine, going to visit some clients that retired out there.
Yeah, good for you. Have a safe trip. And yeah, flying into San Francisco or Oakland?
Oakland.
And then are you renting a car? Or are you
flying into Oakland, renting a car, and driving straight north to Sonoma County when we arrive?
Nice, nice. Well, have a good time. Be safe.
Thank you.
And we look forward to having you back in Kansas City. With me, I got to play in the club championship at Mission Hills, which is always a bit of a privilege. And, you know, I won the first round, Corey. I've never gotten out of round one, and I did it.
Good for you. I was happy for you. When I got a text from you that showed me the scorecard, I was happy to see that.
Yeah, I played really well. I think I was only, you know, 2 over, and we didn't finish the round because I closed out the match. But, you know, great group of people. They had a dinner and all that fun stuff. So it was just good getting to play. And, you know, there's 16 people that play. It's single elimination, kind of like March Madness. I was the 10 seed, and I beat the 7 seed. So it was an upset. And then I had to play the 2 seed, who ended up actually winning the whole tournament. So I don't feel so bad. I lost to the club champion, but it was good. It was a good time and great weather, and so it was a lot of fun.
Good.
So for today's episode, again, thank you all for tuning in. Corey, our subscriber count actually is growing a lot faster than it has traditionally, so I'm really excited about that. So again, if you're watching or listening to Upticks, please like and share a comment, give it a 5-star rating, a thumbs up. Again, this is designed to enhance financial literacy. I don't want you to take anything that we talk about on our show as concrete advice. You always should meet with your wealth advisor who's acting as a fiduciary before implementing any of the strategies or topics that we talk about. But Corey, let's dive right into it.
Let's do it.
Now, I don't want to spend a lot of time on this first one because a lot of our clients don't have student loans, but certainly the title caught my eye, and it says, a new student loan plan promises to lower repayments. Should you make a change? That's a good catchy title, isn't it?
It is.
So there's this new plan out there, Corey, and it's part of these income-driven repayment plans, which are not new. But this new one is called Saving on a Valuable Education, or SAVE for short. And basically, you can get your monthly loan payments calibrated according to a formula that takes into account your family size and your discretionary income. So like other income-driven repayment plans, it requires borrowers to pay a portion of their discretionary income, but the SAVE plan calculates income, and this is what was interesting, Corey, above 225% of the federal poverty level, which normally, or previously, it was 150%. So all this is saying is that you can make more money and your student loans repayments won't be as steep as they were. Now, if you were previously enrolled in the plan called Repay, you're automatically going to be in this new one. Otherwise, you've got to go to studentaid.gov to enroll or sign up. So again, not everybody is eligible, but I thought it was pretty interesting. Thoughts on this, Corey?
Yeah, it is. I think it makes sense for a lot of people. I mean, I've been struck by a lot of people that I feel like haven't really prepared too much for student loan repayments to begin. But I have talked through this particular strategy with a few people, and I know a handful of folks I've talked to that plan to take advantage of just this.
Yeah, now I don't think it's for everybody. Maybe you were kind of alluding to that. I don't think
Correct.
It is for everybody because one of the downfalls is you're still kicking the can down the road. So you actually potentially may end up paying more money back because of interest. But I think there's something that's saying the interest, the won't run up on you. But again, so I think you still need to sit down with your wealth advisor and weigh out like, okay, what if I do this reduced payment plan, or what if I just pay more, and crunch those numbers. So I don't think it's a no-brainer for everybody. And again, loans made to parents, including plus loans, are ineligible. So parent plus loans don't apply for this. But again, if you have student loans, or your kids have student loans, or your grandkids have student loans, the point of this is there are some things you can do to investigate repayment, and there are some options out there. This is not a loan forgiveness plan. So I don't want people to get confused. That's not what this is saying. You're still going to have to pay back your loans, which I agree with. I don't agree at all with this loan forgiveness plan that tried to get passed that failed, because I paid for my college with my parents' help, and me doing it also. So I think everybody else should, so selfishly or whatever. So
yeah, that's thanks for sharing. So the what we have next here is an article I included from Barron's, and the headline was, "The big question for the Fed is not how high interest rates will go, but how long they'll stay there." And I included this because the Federal Open Market Committee, the FOMC, meets this week to announce their most recent decision on interest rates. This has been a crucial point of what everyone, I feel like, has paid attention to as market participants for the last 18 months. There's been a whole lot of talk about the Federal Reserve. And I don't know about you, Jake, I frankly am looking forward to when we're talking about the Fed a little bit less. But with that being said, the article has highlighted how the Fed has raised interest rates from 0 to 5.25% over the last 18 months. But there's been a lot of just evaluation of how much higher is the Fed going to raise interest rates? When are those interest rate raises going to occur? This, I think, did an effective job of highlighting it's less about how much higher the Fed is going to take rates, but how much longer rates are going to stay elevated at the levels that they're at currently. And there was a quote in there, Jake, that talked about more important than how high rates will go is how long they stay there. Because right now, the summary of economic projections from the Federal Reserve expects that they will be lowering interest rates by a full percentage point in 2024 by the end of the year. What are your thoughts on this, Jake?
Yeah, and the timing of our editing and getting everything through compliance, so that by the time the show airs, Corey, we'll be well past the Fed funds decision. It's good. I think it's good, though, that people understand. I like that you shared this, that it's not about if they're raising or lowering. It's about how long are they going to stay high. And in my opinion, Corey, they're not that high. So they are high relative to recent years, but they're not high historically. So I would be okay. My point is, I would much rather see the Fed just maintain them and not jack around with the rates so much. Why are they over raising it and then lowering it again? I know it's a juggle and it's an art, but I don't like the fact that they may raise it again and then they're going to lower it next year. I think that, again, is highlighting the Fed too much and giving the Fed too much control. I would love it if they came out and said, and again, we're going to hear what they're going to say here soon, and it'll be after the show comes out. But I would love if they just said, we're going to keep them where they are for the next 2 years. What's wrong with that? So
that takes all the intrigue and mystery out of it, I guess, Jake.
But I don't think the Fed is trying to be mysterious. I don't know what, but I guess it's very delicate what they say and how they act. I just think it's important, though. I'm glad, again, you shared this article. I think it's important that people understand that raising by 1/4 of a point or lowering by 1/4 of a point isn't as big of a deal as how long do they stay where they are. And that's really what we'll be looking for when the Fed gives their guidance. And again, it'll be after this. So it's a little weird that the timing on this, because this video takes a while to get out there, but I'm glad you shared it nonetheless, Corey.
All right.
For my next article, there's a simple way to lower your home insurance bill. It is also a risk. And so one way, so a lot of people, obviously have, homeowners insurance. And many people may not know this, Corey, but if you raise your deductible literally from $500 to $1,000, you could potentially decrease your homeowner's insurance by 6% on average. And that's according to this website called valuepenguin.com. What I thought was crazy about this article, though, Corey, is that more people have dropped their coverage entirely. And as of June of this year, 88% of owners carry homeowner insurance nationally, but that's down, Corey, from 95% in 2016. So this is according to the Insurance Information Institute, also known, what about this name? Triple I. That's the name of that. That's the name of that organization. So my question to you, Corey, and I'm assuming you can only drop your homeowner's insurance if your house is paid for. I doubt a mortgage company would let you do that. But my question to you, Corey, is would you ever consider dropping your coverage on your home insurance? Like getting rid of it?
No.
Why?
No, not unless I have to, would be a longer answer. But because of the potential for catastrophe.
Wait a minute. No, why would you have to ever drop your homeowner's insurance?
I don't know if I couldn't afford it. I would assume that's why people have been dropping coverage because they
No,
can't afford it.
no. You got that wrong. I think people are dropping coverage because they can self-fund, just like any other reason you wouldn't need insurance. If you can't afford your homeowner's insurance, you probably can't afford your home because your homeowner's insurance isn't the largest bill you pay. It's your mortgage or probably your electric bill might even be higher for some people than their insurance. So I think people are dropping it because they may have 500,000 in the bank or in retirement. And they may say, you know what, Corey, if my house burns down, I'll just pay to have another one built, but I'm not going to be paying these crazy premiums moving forward. But I think it is very risky to do that. I would not advise a client typically to do that. Again, the point of this show is to not provide advice. But I thought it was interesting. So again, insurance companies are jacking up their rates because they've had to pay more in claims. So that's causing everybody's rate to go up. So I guess my one point or tip here is that you should be reviewing your coverage at least every few years, unless you've had a major life event, like you have bought a new home or new car or something. But I think you should sit down with your insurance agent and say, hey, can I raise my deductible to lower my insurance? And what kind of savings will that provide? And then my last tip, Corey, we can move on, is that if you do raise your deductible, you want to make sure that you always have that deductible on hand. Let's say you raise your deductible, Corey, to $10,000. You want to make sure you always have $10,000 accessible in cash, ideally in a treasury bond or something safe, relatively safe, to pay that deductible. But I don't think people are dropping their coverage because they can't afford it. I think they're dropping their coverage because they want to self-insure. Any other thoughts?
Yeah, I don't know. What did the article say? Did the article say it's because people are doing it because of the rates, or people are doing it because they have enough cash to be able to cover it themselves? Because largely my understanding, not is across the country, is that as more insurance companies are moving out of the homeowners policies because of natural disasters and whatever it's been, and because rates on homeowners insurance have gone up so much, regardless of whether or not people have had claims. I've been operating under the assumption and the impression that that's why people are actually choosing to just say, you know what, I'm just going to let the coverage go. Could be wrong.
I don't know. Maybe you're right. Maybe you're
Probably
wrong.
both.
I don't think that'd be a reason for you to do it, though.
Correct. Yeah,
but
fair point.
It's said that people don't want to pay these higher premiums, so that's why they're raising their deductible.
That makes sense.
Maybe I missed why they're dropping it all. Maybe you're right, but I think people. I don't think you should be dropping your homeowner's insurance if you can't afford the premium. Then you should move out of the house and downsize to something more affordable. So, all right, let's move on.
All right, good. The next article that I've included is one from Barron's, and the headline is How to Decide Between Medicare and Medicare Advantage When You Turn Age 65. So in regards to healthcare here, I included this because of the relevance of Medicare in planning for retirement for virtually everyone, and also because it highlights that many people just don't digest the impact of the decision that they make around Medicare at age 65 until they ultimately get sick or until they really need the coverage. So I found it really useful for people. We have clients, Jake, regularly that are reaching age 65, that are retiring, that need to make decisions around Medicare. This talked about, I thought it was really interesting, only 29% of Medicare enrollees, Jake, re-examine their plans during open enrollment, which is coming up this year. In the fourth quarter of 2023 is when Medicare open enrollment for next year occurs. But according to the Kaiser Family Foundation, only 29% of Medicare enrollees examine that plan, and only 10% actually make a change or switch. And that ultimately switching can get complicated depending upon the decision that you make at age 65. The larger point here being, if you are approaching Medicare age or open enrollment and are evaluating what plan you have, it makes a lot of sense to make sure that you reevaluate that on an annual basis. And I frankly think it makes a lot of sense for people to talk to an insurance broker to make sure that they have the right coverage that they're going to need, because life happens and things change as people age.
So you think people should review their Medicare enrollment every year and talk to a broker every year?
Yes.
Yeah, you're right. I guess
Why not?
prescriptions change. Yeah, you're right. You're good point. That's a really good point. Why not? I mean, and now again, we do financial planning and wealth management for a living. So to us, it's very obvious.
True.
I would argue a lot of people in their mid to late 60s or 70s, maybe not a lot has changed, and maybe that's why they don't do it. I agree, though, Corey, it is a complicated industry, Medicare. It has a lot of nuance. And if your prescription drugs or your health situation has changed,
Or your
that
doctors.
obviously is a reason to do it. But you're right. There's these independent health insurance brokers out there that are more than happy, I'm sure, to sit down with you and review, because they get paid, right, based on which program you choose, I would think. But why not have somebody review it and make sure that your plan aligns with what you need? I agree. I agree with you. 29% seems a little low. I would think half, right, would be more appropriate. Because again, if zero has changed in your situation,
Sure.
maybe you don't need to review it. But you're right, it wouldn't hurt. So good.
It does make, yeah, and it makes a lot of sense, though, as they highlighted there, really, that like people make that decision at age 65 and they think about that decision at age 65 as opposed to thinking about what could the ramification of that decision be when I'm 85. People are focused on the short term when they ultimately make that decision, and there's a lot of factors that can influence the right direction to go.
Yeah, good point. Yeah, good one. I got one here for you. You might be paying too much for that index fund. Now, again, at Falcon Wealth Advisors, we don't use third-party products. Corey, we basically created our own product. It's not a product because we're literally buying stocks, bonds, and options for our clients in-house. So it's not packaged up in a retail form or wrapper. But I thought was interesting is State Street, they rolled out, and I'm not going to list the fund because, again, I'm not endorsing this, but it's pretty crazy that they've created a fund that only costs 0.02%. which is really cheap in there. And the article basically argued that whoever has the cheapest fund is seeing the more flows to their products, which kind of makes sense. There's a race to zero almost for this stuff. Now, just to define an index fund real quick, is an index fund is typically, not always, but typically an unmanaged, right, basket of securities. So you could think of an S&P 500 index fund. You would expect to get S&P 500-like returns, but nobody's really driving the boat. You're really just floating in that big blue ocean. And that's why we frankly don't like index funds for our clients, because nobody's driving. And if you have some stocks that are really crappy in that index fund, you could lose money, obviously. And you can always lose money when you're dealing with investments. But I also thought that it was interesting that they talked about financial advisors are really quick to adopt these low fee funds, which I disagree with. And the reason is the whole point of a low cost index fund is the low cost. If you slap on an advisor fee of 1% to something that's only charging you 0.02%, well, now you're locking in a negative 1.02% return against that index. And so if you, by definition, if you're paying an advisor fee to put you in an index fund, you're always going to underperform that index fund because the fees are more than what that index fund is invested in, if that makes sense. And so I think it's good for the do-it-yourselfer that perhaps is using index funds, that's nice. But I don't agree at all with advisors using index funds. I think that's, to be blunt, I think it's stupid for an advisor to put their clients in an index fund and charge 1%. I don't see the value you're adding to a client from an investment standpoint. Corey, what's your thought?
Yeah, I agree with you. I think that you're locking in an underperformance, and I agree that I frankly think that if someone has hired an advisor, and part of what that advisor is investing money for the client, but they're using index funds or mutual funds, I don't think that advisor should charge the client based on the value of their portfolio, because they're not managing the assets. They're just putting it into the broad market.
Right. I agree. Yeah, I agree. And again, good for State Street, right? They're driving the costs down. But, there's also such a thing called direct indexing, where some of these platforms, I don't know, I don't want to endorse any of them, but some places you may be actually able to buy fractional shares and you could just literally go buy 500 stocks. Now it would be crazy to probably do that on your own and very hard. But then you don't need to use a product, right? So I think that's what's creating all this, is that there's just a lot of efficiency coming in the investment world, which is good. It's good for the retail client. And so I agree with it. I don't agree with advisors sold products, though, that are designed to be cheap. That's completely going against the makeup of the product.
Yeah, they're cheap until the advisor who sells it has to be paid, has to
Right.
get paid, I guess. Yeah.
Exactly.
Okay, good. The next update that I have here is from Strategas. This is part of their policy outlook. This is one particular chart that I wanted to, or page here that I wanted to include, that talks about the economy remains the dominant fundamental variable to presidential election outcomes. There is an election in a little over a year. I know, and we've begun to talk about that a little bit on this show. But what I really thought was interesting about this is how clean and crisp and clear it was. And what Strategas highlighted here is that the presidential elections, re-elections, have largely been determined by whether a recession occurs at the tail end of a president's first term. And this highlights and illustrates very clearly that presidents that have not had a recession towards the end of their first term have been reelected. Presidents that have been in office when there has been a recession towards the end of their first term have not. And I think when we think about the next year ahead, I just thought this was something interesting to highlight and for people to see, because there's going to be so much noise about the election, what's going to happen, there are unprecedented events, so on and so forth. This is pretty clear and simple to me.
I'm glad you haven't given up on your chartdom.
Thanks.
I still don't like it, and I love you keep putting them in here. Now, my question for you on this chart, though, is this batting 1,000? Is this every time, or is this just pulling some examples? Do you know?
Yeah, this table shows that every president who avoided a recession in the final 2 years of their term. So I think, given the fact that, Hoover and Taft are on here, I really think it has to do with when presumably the BLS, the Bureau of Labor Statistics, started, defining recessions.
Interesting.
Because it's going back a long way.
It is going back a long way. And so you're saying and when is that recession? 2 years before?
Yep. Yeah.
My argument is we had a recession. We technically had a recession, right? And so,
right, and that's why, and this is arguing that's why Trump was not reelected, is because there was a recession in the election year.
Got it. Wasn't there one in Biden's? Wasn't there technically one? I know people don't call it one, but there was one, wasn't there?
That's a good debate.
There were 2 consecutive quarters of negative GDP. I got to believe there were.
There were
during Biden, but nobody called it a recession. So anyways,
correct.
Good chart though, Corey. Keep them coming. This one's harder for me to shoot down because it's batting 1,000. But again, all it takes is one time for it not to work the way it works. And then this chart is hogwash.
I agree with you. I do want to say, though, and I agree with that completely. My perspective, though, and the point in including this is just to show the relationship between economic activity and elections, because there's so much that people are going to be paying attention to over the course of the next year. I'm not saying that I think it would play out this way one way or the other. I just think that this has largely been the determinant of what's happened in elections.
Do you think, though, perhaps that's why, and I'm not saying that Biden's administration swept it under the rug, but maybe, I'm telling you, I think there was a recession, but it wasn't really technically classified one, even though it technically was one. So again, the definition of recession, I think, also needs to weigh into this. That's a good one. Thank you for sharing.
I define it the same way that you do, though, Jake, just to be clear, the 2 quarters, and we did have that, but it was never defined as an official recession.
Right. So we'll see. We'll see how it plays out. Time will tell.
We will.
All right. I got one here. How private equity stacks up against the stock market. This article was in Barron's, and private equity has turned into this sexy, esoteric, kind of exclusive asset class. A lot of institutions invest into this day, and not a lot of retail clients do. And basically what they are, private equity firms are the go-betweens that raise money from sophisticated investors for funds that buy companies in whole or part. So you can think of these as non-public companies, right? So private, obviously, so not listed on an exchange. The kicker, Corey, is that clients typically commit capital for 10 years 3 to do the deal, 4 to cultivate the assets, and 3 to get out of the deal. Here's a real problem with it. I don't typically like private equities. That fees generally range from 1.5% to 2% of the assets plus 20% of any profits. And also, there's private equity firms that are running funds on loans called private credit and real estate also. The big problem in this article, which I agree with, is the industry says that private equity pays an illiquidity premium. So basically, by locking up your money for 10 years, the hope is that you can make better than market returns. But that basically stemmed from when they started doing these deals. So when the buyout world first started, you buy companies at 7, 8, or 9 times their cash flow. But now you're seeing people buy things at 13, 14, or 15. Because here's the point, Corey. I think a lot of these private equity deals, they're buying up. So like Falcon Wealth Advisors, for example, a private equity firm could buy us out, at some multiple, wait it out. And then when they sell it, they have to sell it at a higher multiple. And they may or may not have done anything to actually improve the company. That's my issue, is that they're trading over the same companies over and over, and maybe inflation or just general business growth is happening, but I don't really see these private equity firms. They're just trading like companies that aren't necessarily worth more. They're just slapping a higher multiple on them. And a Harvard Business School study found that investors can actually beat the performance of these buyout funds using small cap value funds. And they could use brokerage loans for leverage if they wanted to do something similar. So I don't know. I wanted to get your take on it. So again, I'm not against private equity at all. We don't really do it here. I think it definitely serves a role in a well-diversified portfolio for a certain entity or individual. My point is, though, that it's not as sexy as it may be cracked up to be. And if you just have companies swapping other businesses, I don't really know what you're doing to actually create anything. What are your thoughts, Corey?
I think what they're trying to create is investment returns, to your point, as opposed to, that is what they're trying to create. You made a good point, Jake, about private equity firms maybe don't do anything to make the business that they acquired better. They could also acquire a business and actually make it worse before they sell it to someone else. So I think that private equity as an investment, I like the way that the author, explained basically the returns are largely because of the illiquidity. That makes a lot of sense to me, because you're willing to say, I'm going to take this money and I'm going to lock it up for 10 years. You should ultimately receive a premium return for that. But yes, I think that largely speaking, this is something that is more of a discussion with institutional investors as opposed to individuals. And I think that's probably for the best. But I also think that the business in the industry has just grown to be really, really big, huge, significant, particularly in light of low interest rates and raising capital the last decade or so. We haven't seen how an asset class or a style like private equity performs in a higher interest rate environment either.
Yeah, and again, the fees are so high that's kind of crazy. All right, we got 2 more articles, Corey, before we wrap up here. Fire away.
That's right. Yeah, maybe the best way to make money in a private equity firm, Jake, is to own one. But
well, that's what the article said, is that these billionaires are the owners of the private equity firms, not the investors. So
exactly.
I'm sure there are billionaire investors, but you're right. All right.
Yep.
Let's move along.
Okay, good. The next article that I included, this is one I just included today. It's a new article. This is from KCUR, the PBS affiliate here in Kansas City. And the headline is Jackson County Legislature freezes property taxes for seniors after controversial assessments. And Jake, I don't know if I'm sure you've had some conversations with clients about this. I certainly know that I have, but long story short, the legislation is set to basically fix personal property taxes for seniors that live in Johnson County. If they are collecting Social Security.
It's Jackson County, right? It's not Johnson.
What did I say?
You said Johnson. It's Jackson.
Jackson County, Missouri.
So what are they doing? So what are they doing? They're going to freeze property taxes for people how old?
For people who can receive Social Security and whose home has a market value as determined by the assessment process of $550,000 or less.
So 62 years old or older.
Yeah, it just says under the ordinance, homeowners in Jackson County who can receive Social Security benefits. So my presumption would be 62.
Has this passed?
This, yes, yeah, the county legislature voted this week to approve a tax credit, which would essentially freeze property taxes at the 2023 level for currently eligible seniors.
That's pretty cool. I think I'm okay with that. I'd be curious to know how many other counties in the country are doing that, but I don't think it's a horrible idea at all.
Yeah, and I do think that it has been the reality is the whole, the the real estate taxes and the tax assessments in the state of Missouri has been very controversial over this year, in Jackson County specifically, I should say, really over the last several months, because, there's a lot of people that received, I talked to clients that had over 100%
right. We know all that. But my point, I don't know though if I like this, because I still don't. Yeah, I want to redact that statement. I still don't think this is right, because if somebody is 65 years old and they're living in a $500,000 house, and let's say they have $10 million, why should their property taxes be kept? I think the real problem is the Jackson County assessment. I mean, it's stupid how much they raise.
That's the real problem.
People's taxes, really with no basis. So I think they're just trying to do this, Corey, to win votes or win the hearts of seniors. But it's almost as bad. It's not as bad, but it's almost as bad as forgiving student loans. Because why are you making it easy on somebody? It's a piece of property. It shouldn't have anything to do with your age. So
right.
I disagree with Jackson County on that one. I also disagree with their stupid assessments and how high they got. It was dumb.
Yeah, I think that's the real issue. It's not about.
So they didn't solve it. So they didn't solve it.
No,
that's my point. Maybe they solved it for seniors, but they're basically saying we're still going to try to rip off everybody else but seniors.
Correct.
It's stupid. All right, we'll move on to our last one. A little bit more fun, Corey. Get me fired up. Goldman Sachs. Goldman's pitch to rich clients, hey, buy a piece of this sports team. So the bank is creating a sports franchise unit within its investment banking division that will combine sports M&A with sports financing. The top goal is to work with asset and wealth management to pitch wealthy clients on investing in teams, stadiums, and other flashy deals. So my question to you, Corey, is would you ever want to invest in the St. Louis Cardinals? Be kind of cool.
Probably not.
Why not? I'm sure it's worth a lot of money, isn't it?
I don't know. I don't know if my personal opinion is that if I have the opportunity to do that, the way it's probably structured is not intended to really benefit me.
The fees are probably high. The fees are probably going to be high. I think it's an ego thing, walking around. I own some of the Cardinals or whatever. The Green Bay Packers do this, right? Don't the Green Bay Packers sell their season tickets? Somehow a fan, you can buy a share, I think, of the Green Bay Packers.
Yep.
But you're right. I think Goldman is just packaging up something to make money on it for Goldman. I think some of these sports franchises, though, particularly these soccer clubs around the world, are worth a lot of money and have made a lot of money. So again, I'm not suggesting I would recommend it as an investment necessarily. I think it would fall under that other category, though, of artwork or collectibles or antiques, right? So I wouldn't want to be looking at it like a traditional stock or a bond or an option. But good for them. They're being creative, I guess. But I don't know if I would want to buy a share of a sports team. I don't think that would do it for me. I'd rather root for my sports teams and watch them, but I don't want to invest with them necessarily, because that's a whole different thing. It's not the same thing. Like, you can have a losing franchise and it be a great investment, right? So it doesn't necessarily line up your interest, really, in my opinion. So, all right, good. Do you have any parting comments as we wrap up today's episode?
No, I don't. I think no, I don't. Do you?
No. Thank you again for joining me. Thanks for bringing in the chart. You got to bring more of those. Our audience, you got to believe that some of our audience loves the charts, Corey. So keep them coming. I love the local news. That Jackson County, they're trying. It seems like but they've got bigger problems on their assessments. So I don't think
Seems
they
so
solve
clear
the
and
problem.
obvious.
And I'm happy for the seniors. I mean, don't get me wrong. If you're 65 years old and watching the show and live in Jackson County, that's good. I'm happy for you, but I don't think it solves the problem. So, but yeah. So again, thank you, Corey. Thank you for sharing where you are. Thank you for everyone that's tuned in and listening and watching. Continue to like and subscribe and share our content. And we hope all of you have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.